Hello, everyone. Welcome to Pro Buyers Playbook. Today, we will be talking about capital gains tax, negative gearing, and the real supply constraint. So, just before we go ahead, I'll just go through just formal disclaimer. This is not a financial advice. It is just generic in nature. So, if you want any specific financial advice based on your personal situations, just reach out to the professionals. This is just generic advice. um let's just go in now. So there has been a news everywhere over the past few months. Every news channels and every other places are talking about negative gearings, capital gains tax, and what it can actually do to the property industry overall. But some people are saying that could crash the market, and some people are saying that it will fix the affordability, but almost no one is talking about what actually happens next, because property market don't move based on headlines. They move based on behavior, incentives, and supply. Today, we are not here to give opinions. We will be breaking down into realistic scenarios and, most importantly, what those scenarios actually mean for investors, buyers, and for overall property market. So joining me today, we got Dan, his mortgage broker, Kunal, the chartered accountant, and Harneet is our ProBias team member and also young investor. So guys, if you can spend a couple of minutes and introduce yourself, would be great before we kick things in. Dan, can you go first, please?
Okay, I'll go first. Thanks, Kritik. Pleased to be here, man. Yeah, so I'm a mortgage broker, been a broker for the last 4.5 years, helped a lot of clients scale their portfolio. So I focus on helping clients build a wealth through property investment. Prior to that, I was working in the tech industry for 20 years. I truly understand the pain points of, normal people working hard, and they're not certain about, how they should be investing their money in property. So that's where I come in, and yeah, I'm looking forward to this session.
Thank you, Dan.
Hi, I'm Kunal. I'm an accountant. I have an experience of about 15 years. For the longest time, I spent my time with public practice, auditing and doing advisory work for large corporations. Of late, I've been into the property game of myself by investing and managing properties, and then I followed a lot of news around the property market in Australia. And I do help my clients set up right structure, and give them advice where necessary, so that they can benefit from the investment game and overall build wealth out of it.
I am a member of Pro Buyers. I am working with Kritik as real estate agent and also a property investor. So I'm very keen how these upcoming laws would affect me and also all of the investors around Australia. So very keen to see and dive into it. Thanks, Kritik.
Thank you, Harneet. And just introduce myself. I am buyer's agent and also the founder of Pro Buyers. Before we jump on the scenario, I want to assume that all the changes will be grandfathered. Kunal, if you can spend about a minute or so and explain us what is the meaning of grandfathering in terms of your language.
Sure. So basically, whenever there is a tax reform or in general any changes to tax laws, what happens is it becomes really unfair for the taxpayer to pay for more tax or tax under a new regime from what they envisioned at the time of investing. So the relief they provide is if investors have taken position in the market before the changes come into effect, they kind of block that out from the changes. So, and they say all the tax changes or the new reform apply to prospectively looking forward for the new purchase of asset, in our case property, and it won't apply to assets already held by investors before say 30 June. I'm just assuming that is a date, and so that's a pure meaning of word grandfathering.
Let's just set up some of the foundation. There are a few key terms that's been thrown around quite a lot, like capital gains tax, negative gearing, serviceability, and things like that. Kunal, if you don't mind, can you please explain what is capital gains tax to our listeners?
Sure. Capital gains tax, or CGT, is essentially a tax you pay on the profit when you sell an asset. In our case, we largely dwell around property. I'll take an example to explain this. So if you buy a property, say worth 500,000, and you later sell after like few years for 700,000, so you essentially gain 200,000 out of it. Now, currently in Australia, if you hold that property for more than 12 months, you get 50% discount on the gains. So essentially, you have earned 200,000, but you pay tax on 100,000. So this discounted gain of 100,000 gets added to your regular income, and that get taxed at the slab rate that is applicable to you. So this is pretty much like how CGT works.
So I would say, in simpler terms, CGT determines how much profit you actually can keep after you sell the property. Is that correct, Kunal?
So CGT is the tax, and the gain you get is like net of tax after that. So that's the right way of putting it.
Yes. Okay. Thank you, Kunal. And also, while you are there, can you also explain us what is negative gearing? Because there are so many people out there who don't have the right definition of negative gearing.
Sure. So negative gearing, it happens when you make a loss on holding onto an investment property. So when you have invested, like if you're getting a rent of like say 500 a week, and considering all the interest costs, maintenance, and all the other relevant like tax expenses, if you make a like the total cost comes to like 700 a week, so that means like $200 is a loss you are making per week of that property. So the beauty of this allowance is like you can offset this 200 per week of loss. Say that would come to like 10 grand a year, against your regular income. Say a salaried employee gets to offset that 10 grand. So essentially they would save like 3 of it, considering 30% tax rate. So that's how you can manage your portfolio, and if you're making a loss, that actually amounts to a tax benefit.
Yeah, so it's not like a free money. It's like government is trying to support you for short-term mechanism for a long-term investment strategy. Is that correct, Kunal?
Yeah, that's correct. So you have to like spend 100 to get benefit of 30. So that's how it
Yes.
works.
Correct. Yes, that's right. That's right. And that's why so many people gets confused because it's dollar to dollar, but it's actually not dollar to dollar.
Yeah. Correct.
Right. Then let's bring you in now. There is again one term thrown around quite a lot, especially recently, called serviceability. So can you please explain us what that actual term mean in your world?
Okay, no worries. Let's jump into it. So serviceability is the way how the bank actually looks at it, whether you can afford to make the repayment. So once we take a mortgage on the loan, what bank usually does is they look at your income, your expense and liabilities, and based on that, there's a borrowing capacity figure. So the most important point for bank is bank wants to make sure that you can actually service the debt, right? So that's what the serviceability is. So right now, what's happening is, with the interest rate going up and down, serviceability changes as well, right? So with the conversation about, the policy changes, negative gearing being scrapped, I think the first thing that the property investor would need to do is they would need to understand what the serviceability is, how much they can really borrow, and that's the first gate they would have to cross before they jump into this ladder and they start talking about this policy, because without having the finance sorted, no one can do anything with investment. So as people say, the game of investing is the game of finance, right? Yeah.
Correct. Well said, Dan. Thank you. Yeah. So if I just can connect the dots, CGT or capital gains tax affects when you sell the property. Negative gearing is something affects you how you hold the property, and serviceability means is whether you can actually buy it in the first place. Now, before we go on and touch on the tax changes, we need to ground this conversation in reality. Right now, as we all know, we got many issues. This takes all these tax changes and reduction of the negative gearing or capital gains tax. It's all been done to increase the supply, hopefully. But the biggest issues what we have right now in Australia are the supply issue, as I mentioned. The second one is we got a fair bit of a population surge through immigration. And third one is our building industry is also struggling. So there are not enough houses, especially right now where we are sitting in Western Australia. It takes forever to build the property. So there is a building issues, and overall it affects the supply and this demand because of the population, because of the all this housing sorted. It's not gonna go overnight. So tax policy, of course gonna help, but it's not gonna change things overnight. I think that's something we have to everybody needs to know. What do you say, Kunal?
Yeah, what it does is it changes behavior. There's an additional a factor that investor will consider is like if say for example something is a law is changing, then like negative gearing not allowed for new properties or something like that kind of adds to the factor and changes behavior.
Correct. Yes. Dan, from lending perspective, what are your thoughts?
So basically, as we know that, we've seen the rate hike and reduction in the past few years, right? So the serviceability has already gone down dramatically in the last few years, if you notice, except the COVID times, where people were able to borrow so much money. So that's not the case anymore. So in terms of there's definitely an impact that is yet to be seen with CGT changes.
And as a young property investor's perspective, I feel that affordability is already stretched. Like even without any policy changes that may be upcoming, it's not easy to enter the market.
Yes, very well said. We get so many first home buyers coming to us and they all are struggling, even with this old government help. So I totally feel what you said, Harneet. So now, now we understand the baseline, we understand all the terms. Now, the way we will be doing, we will be discussing some of the scenarios because in the May budget, they may have few things coming up, and we don't know what's gonna come. There are all the news and speculations. So we broke it down in sort of different scenarios, and we will be discussing that. I guess the first scenario that I've created is that currently CGT discount is 50%. If that gets reduced to 25%, that means half of what we have, and negative gearing remains the same. So let's start with this scenario one. Kunal, can you please explain from your accounting hat or chartered accountant hat, like how do you see this?
Sure. So currently, if you hold an asset for 12 months or more, you get a 50% discount, like you said. But like if in this scenario, if that percentage is reduced to say like 25%, what effectively means like the investor pay more tax. That's the simple of it. But importantly, it doesn't affect while they are holding the asset. So the taxable event is when you sell the asset.
That's right.
Yeah.
But does that stop people from buying?
No, it just means that they will wear an extra hat of a taxman and see like how they can play around with their portfolios, and that kind of changes the behavior in a certain way. But people driven to like increase their wealth or through the property market, that doesn't change, like it just changes their behavior.
So then how this is going to affect from the lending side if this capital gain tax reduced down to 25%, but there is no change in the negative gearing?
Okay, so this is a very interesting scenario, right? So bank really do not care about your CGT rate. They really care about whether you can actually service the debt. right? So that's the most fundamental thing. So where I sit
That's
with
right.
this is this is sort of like manageable scenario where fundamentally nothing changes from lending perspective, because people can still borrow the same amount of money, and the way people want to access finance would remain the same. So investors can still go ahead and buy the property, and the serviceability will remain the same, right? But
Right.
the impact I see is if people who want to sell their property, right, the exit calculation will get impacted because they will have to pay higher tax on the property that they sell. So they may not have a larger deposit, right? So in the short term, um, in my view, like there would not be any changes in terms of serviceability, but in the long term, if there's a change in the rental market, bank might start adjusting the servicing calculation. So I'll give you an example where, at the moment, bank do not take 100% of the rental income. So if there is a lower vacancy rate and there's a higher demand for rental properties, they may change that policy where they may take 100% of the income, right?
That's
So
right.
fundamentally, with this change, everything will remain the same, and people can still go ahead and buy the property. So I guess long-term investors, they would only invest in property, not just looking at based on the tax position, right? They will look at whether the property is generating enough cash, whether they can hold the property,
Capitals.
whether they can afford it or not. So for long-term investors, nothing will change, but the behavior will change for short-term and mid-term investor, where they want to buy and sell the property because it's not as lucrative for them anymore, the
That's
scenario.
right. As you rightly said, what we are seeing as well. Like, so what I feel as well, that there will be less of a flipping. There will be less of flipping behavior. People who want us to do flipping, buy and sell, buy, do small reno and sell. That sort of behavior might change. But what actually, I think it strengthens the overall market, because people would still invest, and because they still can have a negative gearing, people can still get some sort of capital gains discount. So I guess people will still invest from my point of view. Harneet, what do you think? If this capital gains tax reduce it down to 25%, would it stop you from buying?
Honestly, no. I think my strategy would change, but it doesn't affect me in buying. I would just change how I buy. I would be more careful. But if I want to invest in an asset class, I would definitely do that anyway.
That's great. So the key takeaway is that if this scenario gets into effect, then the market will mature, but it won't crash the market. So people will still invest, but it won't crash the market. So this is a good discussion, guys. Thank you so much. I got scenario 2 now. This is where it gets a bit more interesting. So now we are keeping that CGT reduced scenario, but we are adding negative gearing limited to only new builds. So so everything else, what we said, is capital gain tax will change, and negative gearing is restricted to the new building. So this is where policy starts to influence, I would say, supply. Kunal, what are your thoughts?
That's absolutely right. So if government end up doing this, that would mean like they want to give fillip to supply side of it. Like try to encourage new builds. So effectively, if in this scenario, what will happen is, like, if you buy an established property, you may not be able to offset the losses that we were talking about earlier against your income. But if you buy a new property, you still can. Like, you can take depreciation and all the other relevant taxable expenses against your income and get tax benefit out of it.
Yeah. So I guess people would move towards buying new properties or doing a new construction. Then what actually will do in terms of the serviceability and overall like a mortgaging and people's borrowing power?
So so this is also another interesting scenario. So if the negative gearing was to just limit to new build, I guess like just a fundamental of investing is people would only invest money if they see money, right? Like, because no one wants to invest and not make any money out of it. So basically what happens is, if a builder is doing a project, he would already bake his profit on it, right? So basically getting a construction finance could be a little bit expensive, because what I've seen is, banks are very cautious, giving construction loan. And if people apply for construction finance, let's say, a first home buyer or investor want to build a home, brand new home, they will need to get a construction finance, right? So if everyone's doing construction finance, then bank view might change. So they may so when we order valuation, the valuation might not stack up, which means that
Yeah,
people have to fork out money from their pocket, right? And it's going to be very
correct.
expensive for them, right? So it's all of a sudden it's not lucrative for them. Also, as we know that with the
Correct.
things that's happening globally, the construction cost is rising. So I think from looking from that perspective, investors would not just invest and start building new property.
And also, to add, as a young investor, I feel like if I'm pushed into buying something just for the tax benefits, it doesn't sound like a great decision. And if we are talking about new constructions and moving towards new constructions, the prices are already higher for them. And as a young investor, it becomes hard because affordability is stretched.
So this is the unintended consequence. So policy may push demand into inferior assets, which is not the same as creating good investment outcomes. So, new bill will come with artificial demand spike, established home will have a tighter supply, and rent will have upward pressure. So instead of solving affordability, we may just be redistributing demand into inferior asset and increase overall risk. So I guess this is what we take it as a takeaway, that if we go into the new builds negative gearing, then people will go into buying more apartments and buying assets which is not ideal for long-term growth. So that's, I guess, a wrap for this. The next scenario is CGT reduced down to 25 and negative gearing completely scrapped. So this is even a bit more harsher for overall investors and overall property buyers. That complete removal of negative gearing. Kunal, what are your thoughts?
Sure. So in this case, the investor can no longer offset property losses against their personal income, and so that means like the cash flow really becomes important because what went in the investment decisions prior to this change, the upcoming change, is like the people and the banks used to consider what they can offset against in terms of losses and the negative gearing as we speak. So when this happens, the cash flow is ultimately the important part because that would drive the rents up. I would think so.
Yes, that's correct. Yes. Um, then, what are your thoughts if the negative gearing is completely scrapped off and CGT is also reduced? How it can impact overall borrowing capacity and banks' behavior?
Yeah. Okay. Yeah. So I see a lot of social media posts, and a lot of people are actually talking about it. What's the actual impact, right, for negative gearing? So a lot of us, as an investor, I mean, people who are starting to invest, they know that with negative gearing, it could help them minimize their tax, because if there's a loss in the investment, they can actually offset that loss. So when they lodge their tax returns. But let's say if it's completely removed, the impact will be not only on the tax side of things, it will impact their borrowing capacity as well. Just to give perspective, so let's say I had a client, basically he was ready to buy property a few months back and he had a borrowing capacity of $600,000, right? And we have seen rate hike. With the rate hike, interest rate actually drops as well. Now, if what happen is his borrowing capacity will reduce significantly. So what would happen is, from someone who's ready to enter into property market,
Yes,
might not be ready to buy another property.
that's
Because
right.
he doesn't have enough borrowing, right? So in the short term, definitely there will be an impact on lending for investors, right? But in the longer term, the way I see it is, if there's not much activity happening and if the demand for rental increases, then the rental income will also increase, right? Which will in turn help in
That's right.
improvement of borrowing capacity. At the moment, most of the lenders, they don't consider 100% of rental income. But if the rental market is the policies could be that there won't be any shading on rental income. So
Yes.
in the long term, we just have to wait and see what will happen. But in the short term and mid term, I think the borrowing capacity will be impacted if the negative gearing was to be removed. Having said that, if people are holding existing property, that will be grandfathered.
I think this is where it gets very interesting, because everyone will think that if they scrap off the negative gearing, it will crash the market. But will it really? What are your thoughts, Kunal?
Not necessarily, but because we still have the supply issue. I've got some numbers from the National Housing Supply and Affordability Council in their March to 2026 quarterly report. So, so in 2024, the demand was around like 179,000 dwellings or households. The new supply net of it is like
There
128,000.
you go.
That's like 50,000 gap. Similar gap was not similar, but like 27,000 housing gap was in 2025, and it is estimated it will be 30,000 demand to supply gap in 2026. So that is not getting solved by any of these changes.
That's correct.
But having said all that, the supply is the issue. The other thing I want to bring up is the inflation. So inflation also will determine the supply. If the inflation goes through the roof, then we will have a different conversation altogether.
Yes, correct. Yeah. So Dan, do you want to add something here?
I don't think the market will just crash because people are not investing just for tax purposes, right? They would be investing looking at their long-term goals, right? So I think the mindset of the people will change. People will not just go for quick equity gains. Will not just maybe the flipping activity that will sort of be in a controlled manner. If the numbers stack up, people will go ahead. I think the mindset of the people will change, and people will be more attracted towards property that will perform over the long term, and also people will look at whether they can actually afford to hold the property. Not
That's
just
right.
yeah. So I think in a way, it's not bad as well. Like if you look at it,
Yes.
yeah.
I guess it will remove the investors who, as you rightly mentioned, like for the flippers or somebody who wants like a quick gain, like to entry, quick entry. Harneet, what are your thoughts?
Similar to what Dan Kunal said, like if there are fewer rentals, then my thoughts are okay. Now instantly rents have started going up.
Correct. So that's exactly what can happen because it removes the investors and reduce the rental supply, and which like naturally will increase the rent, and suddenly it will look more attractive because if rent's gonna go up, let's say now typical yield is like 4%, if yield will become 6 or 7% for per se, and it will look more attractive again, and then it might be positively or neutrally get property, and people will jump onto the property wagon again. So I guess the long term outcome is not going to lower any prices or not gonna do anything. It's just I would say it's gonna mature and it will reshape the overall market. I guess that's what I feel.
Sure.
I guess it's very serious if they remove the negative gearing completely, and it will affect pretty much mom and dad investors, pretty much everyone. Because from buyer's agent perspective, people who hold more than 5, 6, 7 properties, I don't think they will be holding into in their personal name, and they may not be looking at even negative gearing. Most of the people who's got more than 5 or 6 properties, they will be investing into trust or company structure, different sort of structures. So I guess for them, it's not going to affect as much, but it will affect more like people who has got just 1 or 2 properties, more like mom and dad investors, and they will put off investing into properties. Overall, it's not good for Australian people because everybody likes to get richer by investing in properties, and this will put them away. That's my feel for this scenario. Yeah, I guess this is very important if this all gets what we had before 1999. So this capital gains tax and everything got introduced in 1999. Before that, we had indexation. So I guess that brings to our next scenario that CGT is going to replace with the indexation. So now let's look at the scenario. This scenario is not been talked as much. And what if we move away from CGT discount and get the indexation method in? Kunal, what do you think? How it's gonna shape the overall market if the indexation comes back?
Sure, I can explain that. Before that, I would just like to like slightly correct you that CGT was always there.
Yes.
The method of getting taxed was different. So as you said, like pre 1999, there was indexation which was used to arrive at the taxable income from the sale of a property.
Right.
So what happens, like indexation is followed by many other countries, and I think it's more fair to anyone. So what happens is like when you purchase a property, say in 2020, there is a factor which gets applied to that financial year.
Right.
And if you sell it in say 2026, so because the dollar value has moved because of the inflation and everything, that means the gain that you made on the sale of the property is not purely your real gain. It's just like the dollar value is depreciated from that point, from the purchasing point to the selling point. So there will be two factors, 2020 and 2026, and the differential will be, you will have a like a revised purchase cost or at 26, and that will be compared to the selling price, and the difference will be the taxation. So in 1999, the government made this change to provide for like a 50% discount tax relief. It was just a, I wouldn't say a lame way of, like changing the tax system, but a more administratively friendly way of factoring for inflation.
Yes.
So because if you can see at the in the background, there are a lot of calculation that goes in to arrive at a factor for a financial year.
Yes.
So that's why they averaged everything out and say like 50% discount on your gain, to give you a relief for the inflation that might have happened during the purchase and the sale cycle. So that's how it works, and I personally feel that it's coming back on May 12th, and it's actually fair. And yes, it discouraged. I think the short-term investor will be discouraged, and government wants investor to have a longer term view instead of a short term view. So that's how I think that it will fan out, but I could be wrong.
So instead of rewarding you with a discount, it removes the inflation component from your gain, isn't it?
That's correct. So discount was nothing but to give to factor in the inflation, but like a much more an averaged way of looking at things. But this will be more specific. There will be like teams, statisticians working out like what was the price index in like 2020 in my example, and what it is now 2026. It gets published every year. Basically it means like if I use the example is like if you bought a property of say like 500,000, the inflation pushes to like 650K. Then if you sell it for like 700K, then the gain is only 50,000.
Yes.
It's not like 200,000.
That's right.
Earlier in the 50% discount scheme, the gain was 100,000.
That's right.
So that's how it's getting changed in this scenario.
So I guess this is where it gets very interesting, because under this system, you are no longer incentivized to chart short term growth. You are incentivized to hold the property for very long term. So if you are holding a quality asset and holding it for long term, the indexation method will help you. But if you want to have a quick gain, it probably may not. And from lending and borrower's perspective, how does this change things?
Okay, so I echo to what you've just said, and also I think what will happen is it will detract, short-term accumulating property, right? The question
Yes.
will be, okay, can I actually afford the property? Is the property good for long term? What am I trying to get out of the property? What's my so the strategy? What you are trying to do by buying that property, it will become more important. And this is probably one of the best option if this was to go ahead, in my view.
Yes, thank you, Dan. Harneet, from young investor, what would you think of this
I
change?
feel if indexation comes in play, it's more logical, because now I'm not being pushed into chasing growth or tax benefits. I'm just focusing on buying a good asset and then holding it for the long run, and that's where I will see my growth.
I think this is it. this is like a big shift because it's not gonna reward speculation. It will reward people who are holding onto the asset for a longer time. Like it will reward the patience over the short-term speculation, I believe. And in the market like Australia, where supply is already constrained, I guess this could actually stabilize the market over longer term. This is what I feel. So I guess if we summarize the impact for a shorter term, less investor will invest because slightly it may have a slightly slowdown in transaction volumes. Probably for medium and longer term, it will have a more stable growth because it will reward people who is holding it for long term. And I guess it will focus the mindset to more fundamentals rather than buy, flip. It will go into the more sophisticated investing, I would say. But like if we look at from a different angle, like if we move to indexation, do we really lose the investor interest? I mean, like I'm just looking at my buyer's agent perspective, because if some of the people who come to us and they want to invest in a property and they may look for a short-term growth, where actually we invest and get a quicker growth. I think people come to buyer's agent with that sort of intention, like where is the hot market right now, where we can get more quicker return. Do you think it will affect those sort of investors? Kunal, what do you think?
I think it does affect the short-term investor. Yes, it changes their behavior completely. But long-term investor remain connected to like fundamentals and like the asset class. So I feel like, yeah, short-term investors, yeah, they will look at things differently. And I think that is also government's intention as well, because like we Australians are obsessed about real estate market, and they want people to be like like more motivated to do different things and to build their wealth, and that's why this long term investor game comes in.
Correct. What do you think then?
I don't think you will, investors would stop investing in property because at the end of the day, we have this. If you look at investment, people can invest in different asset classes, right? So if someone believes in property, that person will continue to build property portfolio regardless of whatever is actually happening, and a lot of people acquiring hard asset is always good. So the behavior might change, but the activity might slow down a little bit. But I think the activity of buying and selling will continue.
Yep. So can you strip it all back? Indexation isn't just about tax, It actually is about how we define the gain in the first place. Because like the value of 100,000 back in 1980 versus today is much different. You could buy 40K, 50K. I was just looking at one of the property in 1987. It was costing $49,000, and now it's like close to 850K. So indexation is just not about tax. It just defines the dollar value with the inflation. So overall, if you look at it, one system which rewards the timing, the other system rewards the inflation, and another one rewards the patience. So I guess resilience. So I guess these scenarios are very much important to discuss, because whichever way we will go, it will change the people's mindset, and especially in our industry, people come to us and they want to have most of the time we get investors coming to us and ask for, hey, where we gonna get quick equity out, where we gonna get quick money out, so to get to buy more properties. So I guess this behavior will definitely change, and of course people will adopt to the new system, but it will also change the way they sort of look property investment in a bigger whichever way the policy will go, whichever tax settings we will operate. I guess the overall fundamentals won't change. So if we zoom out for a second, tax policy is just one part of the equation where if we look at other issues like we have migration, we still got many people coming in. We have issue with the building industries are struggling to keep up with the demand, and we also have this global uncertainty at the moment. And yes, tax policy is lever, but supply is the real engine, I would say. Close this out with one simple question: what would you do right now uh, if have to make a decision for investment? Kunal, what would you do?
I would get tuned into like what's going to happen in on May 12th. Um, I would revisit, go back to drawing board, make some plans about my own portfolio, think of tax effective ways if I can. But the underlying principle would be the like structuring it properly, playing the long game, keep monitoring what's happening in the market, and try to
Tell people is that policy will change, government will change, but the fundamentals will still be the same, like whether you're looking for a
be
supply.
proactive rather than follow the herd.
That's a good one. Good one. Thank you, Kunal. You.
So this is what I would do. First thing is I would try and really think about what is it I'm trying to achieve, in 5 years time, 10 years time, and I would build a strategy around it. To execute that strategy, I would speak to a number of professionals, right, get the right advice, and also I would really understand the numbers, position yourself better by talking to a broker, a buyer's agent or an accountant. So as I said earlier, investment is all about the game of finance. So if once you understand the numbers, you can really work out, hey, can I go ahead and buy this property? Is this property suitable or not? So educate yourself, be ready, and also have the right team in place if you want
Yes.
to execute the strategy. So that would be my 2 cents.
Thank you, Dan. Harneet, what would you do as a young investor?
So my key takeaway from the proposed changes that may be coming is that I'd focus on buying quality, not just chasing tax benefits. So I'd say that's the major takeaway that I'm taking with me.
I guess from my side is the biggest mistake that like investor make is reacting to the headlines. If any small changes in the like interest rate hike or something, people react to it and make their long-term financial decision based on that. We get so many clients, and there is one change in the interest rate rise or something with the little change, people will react to it. But the all the seasoned investors are not gonna stop. They will still be, investing. So and the asset class that you buy may have to adjust, but you just have to find your way to make property investment. And I guess I'm very looking forward to this change and what it can do for the next generation, probably next decade. And I guess we'll have to adjust to the new things, but it'll be interesting times for sure. But before I go, I just have to tell this to all the listeners that policy will change and market will adjust, but fundamentals like supply, demand, and human behavior will always win. So I guess that's about it. Thank you, Harneet, Dan, and Kunal for joining us. Was pleasure having a chat, and look forward to seeing you all again.
So
Pleasure. Thank you so much.
thanks, Krutik, for inviting us over.
Thank you.
Thanks, Ritik. See ya.
Thank